Hello and welcome to the Adhesion Manager Spotlight for today, which is June 27th, 2019. Today on the phone we have Dan Vaccarina, who is the Managing Director at Beacon Capital Management, and he's going to be going over some of Beacon strategies today. So Dan, thank you very much. Please take it away.
I appreciate it very much, Patrick. So folks, I'm going to really hop into this. I'm going to fly through it pretty quick. If there's any questions at the end, we can definitely get to them. But let's start right in. Our story, we position it a lot around the 2013 Nobel Prize for Economic Science. We were founded way before then, back in 2000, but really it crystallized our message in a way that it was like a gift for us. That year, the Nobel Prize for Economic Science went to two different people. I actually went to three different people, but two in our space, in the investment space. Eugene Fama from University of Chicago, kind of the father of efficient market theory, and Robert Shiller from Yale University, who believed that the market created unsustainable bubbles and became irrational. So we had this Nobel Prize contradiction, right? One that believed in the rationality of markets, and the other one that believed that markets became irrational. This contradiction was all over the news at that time, and it's kind of a funny thing that the two winners had completely contradictory theories. Well, we actually believe that these two contradictory theories can actually coexist very well together. We believe that we should be investing in the market. We believe that 90+ percent of the time that the market is the way to go in a very good, high quality asset allocation portfolio. We believe in that. But we also believe in what Shiller says is that the markets create these unsustainable bubbles, and they create these extended bear markets. And what you'll notice is that chart I showed previously, we call that the Fama chart. We call this one the Shiller chart, because now we're highlighting all these long bear markets. And you'll see they happen more often than we like, and they're all characterized by unsustainable bubbles or systematic risk issues. Systematic risk is the dark underbelly of asset allocation. It's what asset allocation people don't want to talk about. See, systematic risk is the risk that's inherent in the entire market. It's undiversifiable, and you can't asset allocate your way out of it. It's what 2008 looked like. It didn't matter where you were at in the market, as long as you weren't not in fixed income, you were going to get slammed. All of these pieces, this is a great diversified portfolio, seemingly, but when the market goes haywire, diversification doesn't matter. So you've got to have some sort of product that deals with these issues. And the reason why that this is so important is math. See, losses are more powerful than gains. And this is a mathematic fact. The easy one to explain to clients is this: when the market's down 50, you don't need 50% to get even, you need 100% to get even. So losses have a greater mathematic consequence on portfolio results than gains do. And here's a couple examples. And what I'm going to go through are actually client-approved pieces that we have to explain this absolutely critical concept to clients, that math matters, that losses have a greater mathematic impact on portfolio results than gains do. Thought exercise number one. We take two different investments. Option one has a 2-year 0% average return. Option two has a 2-year 10% average return. Option one is up 10% in year one, down 10% in year two. It zeroes out. Option number two, it's up 60% in year one and down 40% in year two, 10% average return. which one you end up with more money in, is actually option number one. I would venture to say that the vast majority of clients would look at this and say, I'll give up 40 if you give me 60, right? I'm going to net out at 20. The problem is math. Clients, and really quite frankly advisors, don't instinctively understand how math works when it comes to the losses impacting portfolio results. Losses have a greater impact than gains do. Here's another example. This is called the tortoise and the hare. And all we're simply showing is, in the tortoise portfolio, is cutting all of the returns from the hare portfolio in half. So if we have an up 28% in the hare portfolio, it's only up 14 in the tortoise portfolio. If we're down 12 in the hare portfolio, we're only down 6 in the tortoise portfolio. At the end of the rainbow, you end up with 2.6% average return in the hare portfolio, and you end up with half of that, 1.3%, in the tortoise portfolio. But which one do you end up with more money in? You end up with more money in the tortoise portfolio. Again, instinctively, clients and advisors sometimes don't get this. This is a client approved piece, so clients can be educated on this topic. See, we need clients to understand that they must get off this hare portfolio stuff because of math and get on the tortoise portfolio. They can't, if you're swinging for the fences all the time, what's going to happen is you're going to eventually strike out. And strikeouts are more powerful on the end results than hitting the home runs are, unfortunately. So, is there a solution that combines I got to invest, I got to be in the market, I got to participate, with some sort of protection? When those Shiller bubbles create, when 2007 to 2009 hits, when 2000 to 2003 hits, do I have a solution that's going to protect my clients and protect them against that mathematical impact of losses? Well, we believe there is. We say that we want to move our clients out of hare portfolios into tortoise portfolios or more consistent portfolios. And there's 3 elements to that. You got to maximize diversification, you got to minimize losses, and you got to maintain discipline. So the first thing is maximize diversification. This is the FAMA stuff. This is the Markowitz stuff. This is the asset allocation stuff. Now, what clients need to understand is what diversification is not. Diversification is not the S&P 500. See, the S&P 500, in most instances, is 40% overweight into technology and financials. So 40% of the S&P is driven by technology and financials. What are the 2 sectors that drove down the past 2 major bear markets? Technology and financials. So if you want to be overweight in 2 of the most volatile sectors, the S&P is for you. If you want a well-diversified portfolio, the S&P is not for you. Why is this important? Well, the importance of this education for your clients is you want them to not use the S&P as your benchmark, as your comparative. We have clients that we see and our advisors see that are using the S&P 500 to compare against a well-diversified, balanced portfolio, a 60-40 portfolio. How in the heck are you going to have any sort of legitimate comparison? You're not just comparing an apple to an orange, you're comparing an apple to a stick of corn. It's completely different animals. Clients must understand this. Purely education here. What is diversified? What we simply do is we use 11 Vanguard sector ETFs equally weighted. Very low cost, and we're not taking bets on any one sector. The reason we use sectors is, again, because of math. See, one of the core principles of modern portfolio theory, of efficient market hypothesis, all that University of Chicago stuff, all that Nobel Prize winning stuff, you cannot create a diversified portfolio if your building blocks are doing the same things at the same time. It doesn't matter if you're in 10 different mutual funds, 20 different mutual funds, 1,000 different mutual funds. It doesn't matter. If they're doing the same things at the same time, you're not diversified. And this diversification can be measured mathematically. It's called correlation. And what we know is the traditional asset class diversification, Growth Value International, shows mathematically that those building blocks move very similar to each other and very similar to the market, whereas sectors are much more less correlated to each other and to the market. And the reason is because sectors are like little independent economic units. They do things for different reasons at different times. Energy is a good example, right? All the stuff's going on in the Middle East right now, driving up energy costs. Big geopolitical global issues impact energy. Has zero effect on healthcare. That's going to be based on who's getting elected, what's the domestic policies, what's the new laws, what's going through Congress. That impacts healthcare, not energy. The perfect building blocks is exactly what you want. Also, clients understand sectors more than they understand asset classes. Have them try to tell you what the difference between a growth and a value stock is. Whereas they could probably tell you what the difference between a healthcare company is and a transportation company. Much easier for them to understand. Why do we equally weight it? The reason why we equal weight is because we don't have a crystal ball. We have no idea what sectors are going to be good in any given year. So by overweighting or underweighting, we're taking bets for and against various sectors. We don't do that. We equally weight it. Good example is utilities. If we look at utilities here, 2009, 2010, the bottom of the heap, in a lot of analysis, people would say, I'm not going to invest in utilities anymore. Well, the next year, utilities is number one. Okay, Dan, I'm now going to overweight utilities. Next 2 years is the bottom of the heap again. We can do this with a lot of the different, or almost all the different sectors, whether it's financials at the bottom of the heap, now they're at the top of the heap, now they're in the middle. With equal sectors, with equal sectors, we smooth out the ride. So we get the clients off the hair portfolios, get them in the tortoise portfolio. What you'll notice is, are we ever going to be in the top? Absolutely not. But are we ever going to be in the bottom? Absolutely not. That's what we're looking for. Pillar number 2 is the minimize losses. It's the Robert Shiller stuff. It's the bubble stuff. It's how to prepare for the bear markets. Because understand something, clients only have 2 choices. They either prepare for volatility in bear markets or they ignore volatility in bear markets. That's it. Having a well-diversified asset allocation portfolio is great. But if you don't have a plan for the bear markets, you don't have a plan for the negative volatility, then you're ignoring it. So how do we minimize losses? Well, we basically do it 2 ways. One way is we take those 11 Vanguard sector ETFs and overlay that with a 10% trailing stop loss. It's trailing. So as the markets go up, we keep locking in the gains for the clients. Now also, it's based on those 11 sectors. It's not based on the S&P. So we're looking at those 11 sectors collectively. If they go down 10%, we move the clients from equities to fixed income. So we don't move to cash either. This is what it looks like. This is a balanced portfolio. If we trigger this 70%, our balanced portfolio is 70-30, we trigger all of this equity into fixed income. Our fixed income in these portfolios are 3 Vanguard fixed income ETFs. And if we trigger back in, we go back into full allocation. Now, why do we use 10%? The reason we use 10% is because 10% is kind of like a tipping point. What we know is that when the market hits down 10, 44% of the time, almost half, it goes down greater than 20. As a matter of fact, 1 out of 4 times, when the market goes down 10, it goes down 40 or more. So that's why we use 10%. It's kind of there's some technical stuff involved in it. There's some behavioral stuff involved in it. We now call that a correction. There's a lot more new stuff that happens in this cycle as well. Now, how do we get back in? It's very simple. Again, it's a mathematical formula. We're basically looking at 2 things, time and rebound. Time is measured from the date we get out of the market to whenever the market hits a new low. The longer it takes to hit a new low, the greater confidence, the greater rebound we need to get back in. We don't want to go back in unless the recovery is for real. And we'd rather give up some of the upside in that recovery than to get whipsawed in a fake recovery. Let's show you an example of it. This is showing back through 2007 through 2009 what we would have done during that time period. We would have actually stopped out on August 15th, 2007. From that point, we needed 10% rebound from this low to get back in. The market actually rebounded, not 10%. We don't want a false rebound, so we don't get back in. Eventually, the market hits another low on day 154. Well, if we go back to this chart, day 150, we need 21.4% return to get back in. Well, it's day 154, so exactly we need 21.46% return from this low to get back in. We don't hit the low. We meander. We have like mini recoveries, fake recoveries. Eventually, the market bottoms out at day 460. I just want to make sure we can all hear each other.
Hey, Dan. Yeah, I can hear you. I think looks like the screen share went out though.
Okay, do you want to pause just real quick?
Yeah.
Let me just. All right. Perfect. We had a little bit of technical issues, but we're resuming now. As I was saying before, the market meanders sideways and downward. By the latter part of November, we hit the bottom of the market, the newest low. At this point, we now need 25% from this low to get back in. And we actually hit that by the end of the year. So we got out way over here. We missed all of that volatility of 07 and 08 and got back in the beginning of 09, way down here. So that's how that 2.0, that's how that stop loss works. Now we have another risk management component, which is our 3.0 portfolios. The 2.0 we just talked about was those 11 Vanguard sector ETFs with a 10% trailing stop loss overlay. Our 3.0 is taking the risk management from the portfolio level down to the sector level. So now we're looking at strength and weakness for each individual sector. Now with the sectors, we can't use 10% because we have some sectors like energy, we're selling all the time. We have other sectors like utilities, we never sell. So now we're having to do something different. So what we do is we create 11 separate moving averages and combine those to create something called a normalized trading range. All that simply is where should these ETFs move on a normal basis? And at the bottom of this trading range is something called the bear trend line. At the top of it is something called the bull trend line. If it breaks below the bear trend line, we sell. If it breaks above the bull trend line, we buy back in. And remember, we're doing this at this sector level. So we may be out healthcare, we may be out energy, we may be out, just like right now, we're out material, healthcare, and energy. The other 8 sectors we're in. And this is what it would look like differently. Remember, the 2.0 is all in, all out. If we look at that financial crisis time frame, 2007 to 2009, you see this is what we would have done. instead of being all out in August of 2007, you can see we're dialing out of the market until we're completely out in the fall of 2008. And then we dial back in the market. So the 2.0 is all in, all out. The 3.0 is dialing in and dialing out one sector at a time. The third principle, third pillar, is we want to maintain discipline. We have to eliminate human emotion and create a mechanical approach, because emotions is what gets people in trouble. It's this emotional roller coaster, right? They do stupid things at stupid times. One of our biggest advisors, they actually have over 200 million with us, says that clients are wired to do the wrong things at the wrong times. Advisors' job is to get them to do the right things at the right time. And Beacon's job is to give advisors a tool that does that automatically. Here's an example of that. This is showing, the red is showing the performance of the S&P. The green is showing net inflows and outflows of equity mutual funds here in the US. And what we notice is the maximum buying was basically at the peak of the market. The maximum selling was basically at the bottom of the market. The exact wrong things, the exact wrong times. And this stupidity persists. Going from the bottom of the market all the way through, this is just going through 2012, the market went up 70 some odd % over that time period during that recovery. But with few exceptions, we still had net outflows out of equity mutual funds. So people were buying and selling at the wrong times. And then when the market's recovering, they're still selling and staying out. Wrong things at the wrong time. They got to have a mechanical approach. How does this all work together? See, the 2.0 and 3.0 weren't designed to replace each other. They were designed for different markets. See, the 2.0 is designed for strong trending bull or strong trending bears. A perfect example is if we look from the election 2016 through 2017, 2.0 is a great product for that. 3.0 works great in volatile, semi-directionless markets, kind of like from 2009 to the election of 2016. 3.0 worked great there. The challenge is we have no idea what market's ahead of us. So that's why they really are designed to work together, not separately. So we'll show this in this example. The 2.0, this is rolling 12 months. You can see this is the S&P. The top end isn't too bad. Again, roaring bulls is going to do great. But look when we hit the roaring bears. It does really good then too. And the average, 11.0% versus 9.3%. And this is all net of fees. So that's already with our fees taken out. The 3.0, which is the risk management at the sector level, does pretty well. A much tighter bandwidth, 31 to minus 8.5, so lowers pretty good. And the average is still not too bad compared to the market, especially with the downside. But the beauty is when you combine the two. Combine the two, then you've got the best for all markets. And you can see the upside is nowhere near here, but the downside is great. But look at what the averages are. Still almost 100 basis points better than the market, through all market cycles, that is, with much, much lower risk. What I would say is to you all is take us for a test drive. We have this great proposal system that you can utilize. We can do this by calling into our home office. And this is page 5 that a lot of advisors use when they sell and present this to their client. And page 5, what we're seeing here is the gray is the S&P, the benchmark in this instance. The green is the 2.0 aggressive. It's all in, all out. I'm going to use it as an example. The 3.0, a blend, would show the same thing. And what you can see, Mr. Client, is this. The left-hand tail risk is gone. There is no more green over there. The stop loss stops that. You don't care about what's going on in the Middle East. You don't care about who gets elected. You don't care about the trade. It doesn't matter. You don't care about the things you don't even know exist, the black swans. Those go away. But you also notice, look at the upside. You're also going to give up some of the upside. So when the market's up 25 and we're up 11, you shouldn't be calling me because when the market's down 40, you're not going to be. And what that does is just creates a much more tighter, consistent, tortoise-like portfolio, as opposed to the hair, broad, high standard deviation, large range type portfolio, which is what we want to get away from because of math. So that's it, folks. I don't know if there's any questions. I'd love to open it up to anything you have, Patrick, or anybody else on the line.
Dan, thanks so much. That was fantastic. And just so anyone listening knows, we have your information available on the Adhesion application. So anyone can get in touch with Beacon pretty easily just by searching them on Adhesion. Want to make that sure that's available in case they want to get in touch for your proposal tool, which looks to be
Great.
really, really fantastic there. And just kind of wanted to review sort of in some of the main factors here, what you guys, how you guys do what you do. Basically, these portfolios are designed to avoid those significant losses, enhance those long-term returns just through a number of basic strategies that kind of focus on combining Vanguard's sector-based products with Beacon's risk mitigation strategy. And you guys also have this proprietary stop-loss strategy that's really focused on basically percentage changes. I want to make sure that that's largely correct. Is that accurate?
That's correct. Absolutely.
Okay, perfect. Yeah, this is really great. We have a lot of interest in this. So if anyone has additional questions on this, please feel free to reach out to me or to your relationship manager. And we also have Dan directly available for you guys. So thanks very much for your time today, Dan. I think that's all we got.
Fantastic, Patrick. Thanks so much. And if there's any questions, please feel free to reach out to us. We have regional directors all around the country, 14 of them, the home office, internal team. So we're here to support.
Great. Fantastic. Thank you so much today for your time today.
Thanks. Bye-bye.
Bye.